Hello, welcome to week 9 here after spring break. Starting on retirement plans, any type of contributions that you're going to be taxed on later is what we're going to be looking at for this week. I think you'll find that the second half of the semester is quite a bit more difficult than the first half. So if you thought the first half was difficult, not a lot of good news. We get into more complex items in the second half where we talk about businesses. In this case, we're going to be talking about retirement accounts, which can be a little tricky, and they're only tricky in that you don't deal with them a lot in your day-to-day life like you do with normal taxes, where you have a W-2 year after year, where you have you're filling out tax forms, the basic tax forms like a 1040. Some of those things we deal with quite often, and until we get used to them, they become easier. Not so much with when you're talking about pensions or an IRA, putting money away and knowing what the contribution limits are and what phase outs might be. So we're gonna take this hopefully a little slower than some of my other lectures, just to make sure we have some of the more complex things down. I won't take a lot of time on the a little bit easier to grasp items. So also this week, in this week's class sessions, I have a document entitled something to do with the VITA exam next week, not this week. This week is just good to get used to how to get into the VITA stuff, create an account so then by next week, and I'll talk a lot more about this next week, you can look at the first part of doing the basic exam in the VITA test. What the VITA tests are there for is to actually be able to prepare tax returns for that year. So if you pass the basic or the advanced exam for this class, you would technically be able to prepare tax returns for this tax filing season. Every year you have to repass the test, just like, I have to do it, any volunteers that do taxes with the IRS. Your VITA has to pass the test every year. Okay, so we're going to get in here to Chapter 11, dealing with retirement accounts. A couple things to draw your attention to. Some of the good things about having a retirement account through your work. It's good for you, good for the employer, and good for the employer that they can deduct the amount that they spend and put into your retirement account. The employee can also put into the retirement account, of course. So you could have two different incomes or two different entities putting into your retirement account, yourself and your employer. Notice you're not taxed on federal income until you actually take it out, and you're not taxed on the employer's part either until you take it out. And then when you do take it out, you're taxed on all of it. You're taxed on what you put in and any earnings. But notice here, the key thing, and if you ever notice why your W-2 box 1 and box 3 might be different, 99% of the time it's going to be because of money put away into a retirement account. And I gave a little example here because why they're different is you're not taxed on your federal income tax for that purpose on your W-2 for your wages. However, you still are taxed for FICA taxes. For FICA taxes, they go ahead and tax you right now, even though you don't have the money, you put it away. They still have you pay tax on that amount that you put away. You just don't pay tax on for federal income taxes, box 2 of your W-2. Whatever the employer puts in, it never gets taxed for FICA taxes for that case. So in my little example here, if you had wages of $40,000, you put $4,000 away, and the employer happens to match it, which would be great. So you'd have $8,000 in your retirement account. If you would look at your W-2, it looks like you only earned $36,000 this year, but that's only what's taxable for federal income tax purposes. So therefore, box 2, how much you should have withheld, should match with this $36,000 figure. But then box 3 and 5 are going to show the full amount that you earned for the year. because you don't get to take out your $4,000 retirement deduction. You're going to pay tax on all $40,000 that you earned, unlike with federal income tax. So I give a little example here of how good it is to actually put money away. So in my example up here, we put $4,000 away annually. Actually, it was double that. And if I would earn $4,000 annually for 40-some years, assuming you put it away for all the years that you work, which on average maybe $4,000 would be a good average, you would get over $1.4 million compared to just putting that money aside in a bank account that's not earning any interest. You would only have $160,000. So over $1 million difference just by putting it away into an account that earns an average of 6% per year. 6% may be a little high, but some people can do better than that. But on average, maybe 6% would be a decent return. So then I give you some drawbacks, some things that you can read in here. Let's keep going. I'm going to scroll down here to the different types of retirement accounts that are available, mainly through a work-type atmosphere, and then we're going to look at retirement accounts that you can set up on your own called IRAs, individual retirement accounts. But the first one here, when we talk about contribution plans, these are what you typically would know as 401ks or 403b. There are different number and letter associations. What this number and letter mean is that's part of the tax code. So if you would go to the tax code section 401 subchapter K, that's where they talk about contribution plans that you contribute into and that your employer possibly does as well. And then the benefit plans, those are better known as pensions. So these two items we know, but maybe just not by their official name. So with the contribution plan, typically both you and the employer put money away into a special account. So you put money away into, say, like TIA, CREF, or the Hartford. That money is really yours. And as long as there are a few maybe restrictions here and there that the employer can put on, but technically that money is yours, especially the money that you put away into the plan. The good and bad here, let me skip down just for a second here, the risks. The risk is on the employee. Well, what I mean by that is once you retire, once that money runs out that you put away and that the employer puts away, then you're relying on Social Security or however other means you're going to fund yourself through the end of your life. When you have a pension plan, the risk is on the employer. That's why pension plans are going out of style real fast. Employers don't want to have to pay for longer life. People are living longer, so therefore they're having to pay out more expenses on a yearly basis to pay for their retirees. So with the pension plan, the risk there is on the employer. Now, it could be a possible reward if the individual dies right after retirement. Then they don't have to pay them anything. They can keep all that money and keep investing it. With the employee, if the employee dies early, then that 401k money that they have just goes on to their heirs, so they don't lose it. So there's a risk-reward for either side looking at it. But, which are you putting away enough into your contribution plan to hold yourself off for the rest of your life? That's what you've got to plan for. So how much can you put in a yearly basis? This is what this is the limits for the year. So if by chance you had that much money, you and your employer together could put in $52,000 a year, and none of that will be taxed until you take it out, and the earnings would also then be taxed as well. Just you yourself, out of the $52,000, you could put in 17 of that. The employer, if they were going to get to the 52 would have to put in the rest. But you yourself, out of the 52, can put in 17,500. Again, that's all retirement accounts together. So if you have more than one 401k, then the total amount you can put in is the 17,500. If you're a little bit older, notice you can put in an additional 5,500 to catch up. I talked about the good and the bad here. What's a new thing that's started within the last couple of years is employers have the option, they don't have to, but if they have a 401k, they can automatically enroll you in it and start having you have deductions taken out of your account up to whatever they want, not to exceed 10%. But you always have then the option of checking a box on your initial hire form to say, no, I don't want to have a 401k set up on my behalf. I'd rather not, for whatever reason. So and employers do have this right now to automatically enroll you, and then you have to go in and do an opt-out. This simplified plan, this is for smaller companies that still want to have something similar to a 401k, but not with all the rules and regulations. So that's what this is talking about here. The simplified pension plan. I'm not going to talk about a whole lot of this. The only thing to really know is how to set up this little formula, and knowing that the formula meaning you can't put away more than 25% of your net income. And notice that net income includes however much you're taking out of for your retirement plan. So this is the simplified employee pension. What I wanted to get to more was the simple plan, and this is maybe a little bit more popular, more common, in that there are very minimum rules and regulations. As long as you have less than 100 people, you got to make the plan option available to everyone, for those making over 5,000. And the only thing that is required is the employer has to put some money aside. They can put more, but they have to put at least a minimum of match. They can pick whatever one they want to do, and then they would stay with this option, up to 3% of what you put in, or up to 2% of your salary, regardless of anybody puts in it. So they just put in a straight 2% for everybody into an account, or they say, well, if you don't put anything in, we're not going to put anything in, but for those who do put in, we'll match you up to 3%. Okay, so this defined benefit plan, the pensions, they're a lot more complicated, and I'm not going to talk a whole lot about this because your employer would be dealing with this. But just note when you deal with pensions, if you've heard of people like in Enron or there are Arthur Andersen, different companies that have gone out of business, big companies, and their employees were relying on these pensions, and all of a sudden the pensions dried up because the company didn't make it, they went bankrupt. Some companies fund their own pension plan in themselves. Now that's not it's kind of frowned upon, not necessarily frowned upon, but that's kind of the term I want to use. If you fund it yourself and you take care of it yourself within your company, say Walmart had a pension plan, I don't know that they do, but just if they did, they would fund it and take care of it themselves. Well, that kind of puts a lot of pressure then on the people who are looking to get that pension later if Walmart would go bankrupt. Because if they go bankrupt, good chance that this pension plan is going to go bankrupt as well. Nobody's going to be putting money into it, and eventually it's going to run out. If the pension plan is run by a third party, it's still going to run out because people are not going to be putting money into it anymore. Walmart wouldn't, but at least the money that's in there wouldn't be look very desirable to Walmart to try to save their business and take money out of the pension plan, which definitely could happen. So it's good for the employee perspective, at least, to have that pension plan funded, or not funded, but taken care of by an independent third party. You have to be so big of a company, and the state will grant you that exception if you do not need a third party. So how you're going to get your benefits, here's a little explanation, and I give you a little rundown of how companies are not choosing to do pension plans anymore because of the risk that I talked about. So that's why I'm not going to talk a whole lot about this. Let's go down to the IRA options. IRAs are there for any individuals that do not have a retirement option available to them at work, or they basically have their own business, and so therefore they don't have a company-sponsored retirement plan. If that's the case, then the IRA is what you would want to default to. Now, the typical rules, the general rules are if you don't have any other retirement account, you can put up to $5,500 away. Notice that's quite a bit less than the 401k. If you go back up, the 401k was you could put in up to $17,500. So quite a bit less. You can only put in up to $5,500 into an IRA, or you can put up to $11,000 if you're married. Okay, so you can put in for you and your spouse $5,500 each. If you are over 50, you can put in up to $6,500. Just kind of note that there is that catch-up rule again. So if you are nearing retirement age and you want to put more money in faster, you are allowed to do that up to $1,000 more. Notice these contributions, you can take a deduction for any IRAs on your 1040. Then you could say, well, what's better? Is it better for me? Because if you remember back to week 7 where we talked about credits, you can take a credit on your 1040 as well for any retirement contributions you have, but the main factor there was the limit. With the credit option, you have to have fairly low income to even get to take any type of a credit, and the lowest was 10% of the amount you put in. So 10%, is that going to be worth it, or is it better to take the full $5,500 off as a deduction? Well, that's one you would just kind of have to play with and see which one is a better option for you. But anybody making over, I don't know the number off the top of my head, but it was something about $50,000. If you have income over $50,000 between you and your spouse, or just you, then you can't take the retirement credit at all. So you would just default to getting to take $5,500 off of your income on the front page of the 1040. And note one allowance that the IRS allows you to do is if you find yourself owing a little bit of money in taxes and you would prefer to put, and you decide, well, I haven't put any money away, you can put away money up until April 15th and still count it as though you put it away in the previous year. So therefore, you can still deduct it on your 1040, take your income down, thus your tax due down as well. So it's treated just like a 401k therefore. If you take it off of your 1040, that's the same as not including it in your W-2 in the first place from your employer. So your employer, if you put money away into your 401k, they just don't include it in your wages. It's taxable. Here, yeah, you paid tax on it, but then you can take it off and show it as a deduction, therefore not paying tax on it later, not paying tax on it at the end of the year, and potentially getting some of that money back. Also, for 401ks and regular IRAs, your deduction contributions, you're not allowed to put money into these 401k or IRAs after you reach the age of 70 and a half. Once you reach the age of 70 and a half, you can no longer put money into a retirement plan. The only retirement plan option that you would have at that time would be a Roth IRA. A Roth IRA would be your only option. We're going to talk about a Roth IRA in just a little bit. Now, remember, with the IRA, I had mentioned it's for those mainly who do not have a retirement plan at work or some other option to them. If you do have a retirement plan available to you at work, you can still do an IRA as long as you haven't put in up to $5,500. And if you haven't put in, whatever you put into your 401k counts off of that. So if you put in $5,000 in your 401k, you would have $500 left that you could put into a IRA. So $5,500 is the most that you can take. Now, if you are in a qualified plan or have the option, and it's always marked on your W-2 if you have an option. If you ever notice box 13 of your W-2, one of the boxes there will say retirement plan, and it'll be checked or not checked if you don't have the option. If it's checked, that's how the IRS knows that you have a potential to be in a 401k. Whether you are or not is irrelevant. If you do have the option, then your IRA limit becomes limited. Your IRA being able to do anything with it. If you make under $60,000, then there's no issue. You can put in the full $5,500, assuming you didn't put anything away in your other account, your other 401k option. If you make over 70, you no longer have the option to put anything away and deduct it as a deduction for an IRA. You can still put money away into a retirement account, it just won't be deductible. It would be basically like putting it into a Roth IRA. Married filing joint, the numbers are a little bit higher but not double, which again I don't think is quite fair. I believe they should be doubled of what a single individual is. And then if you're in between, that's what my example here is going to show. And it's just like some of the other phase outs we've done before. You can do it the book way, but that's a two-step way. How the book shows you, the way that I do it is a one-step way, where you just get the amount that you're allowed to take as a deduction. Where the book shows you, it says the answer you get is what you're not allowed to take, and then you have to subtract that from what you are allowed. So it's a two-step process. With my way here, it's only a one-step, and we'll look at that right now. So if we have somebody who is AGI of 100,000, how much can they deduct as a deduction on line 32, the IRA line? If they are currently eligible, which is what this area is for, if they're currently eligible for an employer retirement plan, and we assume the individual is 45 years old, thus they don't get that additional $1,000 bump from the $5,500. So I say, okay, if the individual is single, how much are they allowed to put in? Well, if they have an AGI of 100,000, the cap is 70, so they're not allowed to deduct anything for their contribution. For married filing joint, they are allowed to deduct, but they will be slightly limited because they are in this phase-out zone. So I'm going to bring up my answer sheet. So if they're single, none. If they're in between that limit of the bottom phase-out and the top, remember the way that I do it is take your top phase-out number and then subtract it from what you made, what your AGI is, and then divide everything by the span. What was that phase-out span? And if you look back to my notes here, the phase-out span was, there was 20,000 in between here. So that's where this 20,000 came from. So when you do the subtraction here, 16,000 over 20,000 is 80%. You're allowed to deduct 80% of the $5,500 that you would normally be allowed to deduct. So you could put in and deduct up to $4,400 if you're in between the phase out. All right, so now if you are married and the one spouse does have a retirement option, but the other spouse does not have a retirement option at work, you're not considered to be in a plan just because the spouse is. So there are special rules for those who have, for the spouse who does not have a retirement plan at work. The phase out is a lot higher for those individuals. Now, for the spouse that does have the retirement plan, they have to follow these rules, these guidelines. For the spouse that doesn't have the retirement plan at work, but the other spouse does, then they get a much higher phase-out range. So if we have a married filing joint and only one spouse has a retirement plan option, how much, and I notice here, can each spouse deduct for an IRA? So if I say we had an AGI of $140,000, the spouse that does have the plan, they're over the limit. Because this is for spouses with plans. They're over the limit. However, the spouse that does not have the plan, they're not over the limit. They're not even under the low end. So they could deduct all $5,500. With Part B, it's even higher yet, so the first spouse still isn't allowed, of course, wouldn't be allowed to put any money away. They are over the top. However, for the spouse without the plan, they're in between now. And so we would have to do that phase out. Take the 191 minus your AGI, and then divide it by the span. The span here being $10,000. Let's look at the answers. So here's kind of a wrap-up of what I talked about. The spouse with the plan, nothing. No plan, they can deduct all of it because it doesn't even hit the phase out, the bottom. And then we had 186 here. Spouse with the plan still obviously would not be allowed to deduct anything. We actually make more money. With spouse with no plan, they can take half because 191 minus what their AGI is 5 over 10, the span, 2750 would be our amount that we could contribute and deduct. Notice I kept saying that you can contribute and deduct that $27.50. You can still contribute money into an account even though you may not be able to deduct it. So even though you've already reached the limits, you could still put money away into interest-bearing accounts. All right, Roth IRAs. Roth IRAs. Roth IRAs are designed for two purposes. One is for those that can't necessarily do a regular IRA. A Roth IRA would be the next best option. And what I mean by those who can't is because they've hit these limits. They've hit these income limits. So if you want to put extra money away, you could and use the Roth IRA option because it has higher limits. The other reason that people like to use a Roth IRA is they put money away. The bad part is it's taxed right now. All of the amount that you put away is still being taxed. You're not deducting any of it. The good part is all of the money that you earn on a Roth IRA is not taxed ever when you take it out. So remember, with a regular IRA or regular retirement plan like a 401k, you're not taxed right away. You're not taxed up front. But the bad part is you are taxed later and taxed on the earnings. Whereas with a Roth IRA, the bad part is you're paying tax right now on that earnings. On that, say, $5,500, you're not getting to deduct it at all. The good part is when you do take out the $5,500, of course, it won't be taxed because you already paid taxes on it. And any earnings that you have made on that $5,500 would not be taxed either. So that's definitely the upside to the Roth IRA. So some key points here: it's not deductible. You don't put it on the 1040 anywhere. Any withdrawals that you make, good news, none of it's taxed, even the interest earnings that you had. Notice the contribution limits are the same. Also, the step up is the same, so you can put away $5,500. So you typically will choose, I want to put $5,500 into a Roth or a regular IRA. You can't put $5,500 in both. You're maxed out at $5,500 total. Another opportunity is, remember that at 70.5 with a regular IRA and a regular retirement account with your work, you can't put in money after 70.5. With a Roth, you can. Some phase-out limits. There are a couple limits here. If you make over 129 or married 191, then you can't participate in the Roth and get that tax-free benefit. You can read through the rest of that. All right, let's talk about IRA plans and distribution requirements. Distribution requirement, they do require you, as you may or may not know, that you have to start taking money out at a certain time, at a certain age. But we're going to begin to look at that here, but we're going to look at some of the other basics of when can you take money out. And then in just a little bit, another page or so, we're going to look at when do you have to start taking money out. So this is when can you, basically. And the when can you, you can take money out once you reach the age of 59 and a half. Once you reach the age of 59 and a half and you start taking money out of a retirement account, you're not going to be penalized. Even if you are not officially retired, that's not a problem. So you can begin to take money out, no penalty. If you do take money out before this, then you are charged a penalty, as you can see here. There is a 10% penalty in addition to paying the normal taxes. If you take money out of your regular retirement account before you're 59 and a half, you will be charged an additional 10% penalty in addition to the normal taxes that you would have to pay on that distribution. Now, there are some exceptions to not have to wait till you're 59 and a half, and these are for IRA only rules. So if the employee becomes disabled, then the 59 and a half goes away. If you have medical expenses over 7.5% of your AGI, you don't have to wait. Paying for higher education like college, if you put money into an IRA and you decide to go to college, you can pay for it out of that if you would like and not have that penalty. You're still going to pay tax. You're still going to pay the tax to withdraw, but you won't have that 10% penalty. And then paying for first-time home buyers up to $10,000. Note, these are for IRA only. If you have a 401k, that's different. You cannot withdraw money from a 401k and pay for these and not avoid the penalty. The Roth IRA has a slightly different rules. You've got to have your money in a Roth IRA for 5 years since the plan has been opened. As long as you've had the plan open for 5 years, you can start taking the money out. That's really one of the main obstacles with a Roth IRA. That's one of the extra little items there. Is you just have to have the plan open for 5 years. Notice if you do break it, if you do not have it in there for at least 5 years or break any of the other rules, you will have a penalty, but only on the earnings, not on everything, because it would be unfair to tax you on the amount that you were already taxed on in the first place. Now, so that was when can you start taking it out. When do you have to start taking it out? Well, as I say here, the government definitely wants its taxes. So if you haven't started taking money out by the age of 70 and a half, then you have to start taking it out. Otherwise, you'll be penalized if you don't. So you have to start taking money out and paying taxes on any 401k or IRAs that you have. And this is crucial here. You have to begin and withdraw it by April 1st. And then the wording, you just have to go through this real slow. Of the calendar year following when you reach 70 and a half years old. So for me, I reach 70 and a half. I would reach, my birthday's in July. So I wouldn't reach 70 and a half until that next January. So therefore, I could wait until the following April, not even the current year April when I'm 70 and a half. I could, so say I was 70 this year. I wouldn't turn 70 and a half until, I'd say I turned 70 this year in July of 2015. I wouldn't turn 70 and a half until January of 2016. Therefore, I wouldn't have to start taking out any money until April of 2017. So again, and let's go through this just with my little example here. So Joe has a birthday of June 30th, and he'll be 70 this year, and let's assume we're in year 2014 for that tax year purpose. So he'll be 70 and a half on December the 30th of 2014. And the rule is you have to begin to withdraw by April 1st of the calendar year following. So the calendar year following would be 2015. So this individual has to start withdrawing by April 1st of 2015, this upcoming year. They then have to have his normal second distribution. You have to have a distribution then at the end of every year after that. So he would technically have 2 distributions in the first year. And then he would have his third one December 31 of 2016. If not before. You could definitely do it before. And you'd have to have at least 1 distribution every year after you turn 70 and a half. So with this other individual who turns 70 one day later, Betty gets to wait a whole another year. So she doesn't turn 70 and a half until January 1st, 2015. And the rule is the calendar year after you turn 70 and a half. So she gets to wait till 2016, and the second withdrawal by 2016 at the end of the year. So then you say, okay, I know when I have to start taking money out, but how much? Your plan will tell you. You'll have a letter, you'll have something come in the mail that says, we've done the calculations for you, this is how much you have to take out. But what I wanted to show you is how they get to that calculation. And if you look in your book, as I have there, Table 3 on page 11-26. You can see at the top, it's for unmarried owners or married owners whose spouses are not more than 10 years apart. And so it's basically most people fit into this. But it's telling us then how much it's telling us kind of our life expectancy in a way. So if you're 70, they're saying you need to dwindle out your earnings over a 27-year period. We're gonna set it on the high side and say you're gonna live to be 97 years old, just in case you do actually get that old, and we still want you to have money. So we're going to start taking it out over that type of range. And then as you can see, as you get older, the numbers change to account for you getting older and the chances that you might live a little longer. As you get down to 97, it still allow you to take it over another 7 years. So let's look at how you actually calculate this. All right, so Joe turned 70 on February 15th of 2014. And he has $550,000 in his account at 2014. And we need to determine now how much, if he has a balance in his retirement account of $550,000, how much of this must he start taking out? Okay, let's just go through this example. So he turned 70 and a half in 2014, so by April of 2015 he does need to take money out. And you simply just divide it over the span that they give you. So if you have 550,000, divide that out over 27.4 periods. He has to take out $20,073 by the 1st of April in 2015. So by the end of the year, your account, whoever holds your money, will have to tell you how much money, they'll tell you how much you have to withdraw. But if you wanted to figure it up, you could do it yourself, and they could tell you how much you have in your account, and then you find out what is your age at the end of the year. And this individual's age at the end of the year was still going to be, see, they didn't turn 71 until next year. So at the end of 2014, he was still 70. But in 2015, he'll be 71 and going on from there. Let me go back up here and look at the penalty. The penalty is you're going to be penalized 50% of the amount not withdrawn. So you're going to, basically that should never happen. You're going to just take the money out, put it into something else if you don't need it. Put it into the stocks or bonds or whatever you want. If you still want to earn interest, just don't leave it in there and be penalized by it. Okay. E here, Alice, she's not going to turn 70 and a half until 2015. So in 2015, that's the amount that we're going to be concerned about. What was our balance in 2015 when we actually turned 70 and a half and we had to start taking money out? It's kind of irrelevant what the balance was in 2014. So I look at 2015, I earned some extra interest. Maybe I put in a few more dollars. Whatever reason, it went up a little bit. So we do the calculation for Alice. She doesn't turn 70 and a half until 2015. So that's when we need to know our balance. And at the end of 2015, she is 71. So that's why we use 26 and a half as a distribution period instead of the 27.4, because she is 71 at the end of 2015. So it's not terribly difficult. All you got to do is just determine what age are you when you have to start taking it out at the end of that year, and then simply divide how much you have over the number there in table 3, and you can determine how much you have to take out of your account and not be penalized. Okay, so what about if the 401k owner dies? If that's the case, then as I state here, we're going to use table 1 on 11-25. So if my example of Jerry dies in 2014, Susan, his daughter, is his beneficiary. She's 61 years old. She has to start taking money out of her account or out of his account that's now in her name. If he had $100,000 in there, she would have to divide that out over, if you look at 61 years old, 24.4 periods. She would have to take out that amount, 100,000 divided by 24.4, and then next year whatever is left in the account divided by 23.4 to take out the required minimum. Now you can always take out more, but you at least have to take out that much. Rollovers, I think these are a very important thing to mention. A lot of people have rollovers when you quit a job and you move to some other job. and you had a retirement account, at some point you'll have a rollover. The best thing that you can do is have an institution-to-institution rollover. That's called a direct rollover. It's the best by far in that if you have that option to do that, say you take it from the Hartford and you put it into your TIAA CREF, your new job, and you tell them you want it all rolled over. You don't see any of the money, none of it gets taxed, and there's nothing you have to do. It's by far the easiest. If you actually take out the money that the company sends it to you, they're going to send you all of it except 20%. They're going to hold out with tax. And it's your job, if you don't want to have to pay that penalty, that 10% penalty, it's your job to then reinvest that money into a new retirement company or an IRA. And if you don't reinvest it all, then you're going to have to pay that 10% penalty. So with your retirement account, if you had $10,000 and it was a non-direct rollover, meaning the Hartford gave you a check and said, hey, you have $10,000, we're going to write you a check for $8,000, we're going to keep $2,000 of it just in case you decide to keep the $8,000, therefore we withheld the right amount of taxes. But if you so decide that you don't want to have to pay a penalty on that $8,000 as well, then you better put back all $8,000 plus somehow find an extra $2,000 that they withheld, put all $10,000 into a new account within 60 days. If you do that, then you won't have that penalty that we had discussed, that 10% penalty. Okay, the last area that I wanted to discuss is the annuities. Annuities can be difficult, definitely at first, but make sure you're using the right table. The main table that we want to use here is on page 1127. Annuities that have a specific time, like 5-year or 10-year annuities, are definitely easier than the lifetime, because with lifetime, we don't know how long it's going to be. That's when we have to use the table 5 figures. Table 5 figures give us an estimate of the lifetime. All right, so what you're taxed on? You're taxed on basically what your earnings are, not what you put in up front. So with an annuity, what an annuity is you put away $100,000 with some company, and they agree to pay you, say, $12,000 over the next 10 years. So you're actually earning money. 12 times 10, that's $120,000. So if you get paid $12,000 evenly over the next 10 years, and you started out with $100,000, well, then that $20,000 that you earn will and needs to be taxed. And it's just how is that $20,000 taxed? That's what this section is going to deal with. How is that extra amount that you have earned actually taxed? Okay, so if you actually know the amount or the full amount you're going to get back at over a specified time, again, that's the easy way. So I did a little example here. This part A here. If you must find the expected return on your investment. Part A is showing you the easy way. If it's a set of time, like 10 years, like I had said, and they're going to give me $12,000 a year, well, that was $120,000. So in this case here, I get if I put away $20,000 in my little example, and they're going to pay me $500 a month for 5 years, I can easily determine what my total payout is going to be. $500 a month times 12 months in a year times 5 years, I'm going to get $30,000. Now let's go down to Part A, or I'll come back to Part B in just a minute. So now the first step that I've uncovered here, I know that out of the 20 I put in, I'm going to get 30 back. Second step here is finding out what the exclusion rate is. how much of my money should not be taxed. So the base price that I paid in, $20,000, divided by $30,000, the total I expect to get back. So I'm not going to pay tax on 66.7%, or out of the monthly amount, $333. The remaining part would be taxed, 167 times 12 months. I'm going to be taxed on $2,012 for this year of interest. That's the easy one, because I knew exactly how much I'm going to get back over a period of time. The not so easy one is when you're going to get paid a certain amount based on your lifetime. And of course, nobody knows how long you're going to live, so we have to use the charts. And that would be the chart there, chart numeral B5. What the chart does is, so they tell us how long we're going to live, or they're going to tell us what we need to expect. So in my case, going back to this example here, I'm going to receive $500 a month. So that's going to be $6,000 a year times it by 12. And let's say if I'm 50 years old, I look at my chart, and for somebody who is 50, I look at table B, 33.1. So they're telling me I'm going to be receiving $6,000 for 33.1 years. So they expect me to earn $198,000 based on my $20,000 investment. So then I could go down here and do the math. I could go down here and say I have 20,000 divided by 198. I'm going to get a percentage, and then 500 times that percentage. It'd be a very small percentage. I'll just do it here on my side calculator. 20,000 divided by 198,600. 10%. So 10% of whatever I receive is not taxed. So only $50 would not be taxed. The rest, 450, would be taxed. 450 times 12 months. Once I have recovered, and I'm doing a lifetime, if I have recovered all of the money, so that $50 times 12 would be, once I have recovered $20,000, the amount that I put in, if I did live longer than that exclusion ratio says, the 33 years, I think it was 33 years. If I live longer than the 33 years tells me, from when I was 50 years old, then the rest of it is taxable every year after that, all of it, because I'd already returned all 20,000. Okay, 2 more examples, and then we'll call it a day. So if Carol has 200,000, she pays 200,000 and opts to get a 10-year annuity. It pays her $2,000 a month. How much will be taxable income of the $2,000 per month? All right. Well, before we can determine what's taxable, the first thing we have to do is find the return on investment. So I'm going to receive $2,000 per month for 10 years. 2,000 for 10 years, 12 months a year. I'm going to get back $240,000 from based on my $200,000 contribution. Next, we can do the exclusion ratio, 200 divided by 240. So 83% of whatever I receive back is not taxed. So if 83.3% is not taxed, just take the difference. 16.7 is taxed. $333 over a year, then $3,996 would be taxed out of the, remember I get $2,000 a month, so 2,000 times 12 months would be 24,000. Of the 24,000 I received, only just under 4,000 would be taxable as income to me. Last item. This is a lifetime annuity. This pays for $800 a month per life. 72 years old. Well, we don't know to get our first thing here. What's the expected rate of return? Well, she's going to get paid $800 for life. We don't know how long that is. That's when we have to use the charts. Age 72, 14.6 years is estimate. So she's going to get $800 per month for 12 months for 14.6 years. $140,000 when she paid in 50. So we've got the exclusion rate, which shows 35% being not taxed, the rest being taxable. And that is how we got the answers for this situation. Now, the only other thing that I wanted to draw your attention to for a couple of the multiple choice is on page 11-14. If you have distributions from a pension plan, you will want to use the tables on page 11-14. If you're married, you use the bottom set of tables, of course. If you're top, you would use the first. If you're unmarried, single, you would use the first table. And that's if you are taking money from your qualified pension plan. And you want to know, I put in, because with a pension plan sometimes, and this is only for pension plans where both people put in money. If the employer puts in money to a pension plan, which is custom, but the employee also puts money into the pension plan, if it had only been the employer putting money in, all of that money coming out would have been fully taxed. If the employee put in some as well, then a portion, just like in the annuity, is not taxed. And that's where these numbers are going to come into play, the number of anticipated monthly payments. Notice that's monthly, not yearly. You're not going to live 360 years. That's monthly, 360 months, if you're 55 and younger. So if you put money away into a pension plan along with your employer, you have to then be able to determine how much money did you put away. If you put away $100,000, then you would need to divide that $100,000 up over, say, 310 payments if you were between 56 and 60 and you started taking your pension. So you would have to know how much money did you put away, and then you can not be taxed on. Divide that 100,000 or so, whatever it is, over those estimated payments that you're going to be receiving. Okay, be sure again to email me your answers by Thursday night, Friday morning by 8 a.m. and I will gladly check them over. Again, this is a much tougher week, and I will see you next week.